Well, thank you for joining us today, everyone. As what Josh just said, this is probably one of the tougher panels to be on right after lunch, but hopefully we'll be able to talk about this exciting topic and really stimulate some questions too. We will be taking questions either through the apps or at the microphones at the end as well. So my name is Christopher McDaniel, and I'm the president of the Catastrophe Resiliency Council, which is one of the 19 affiliates of the institutes. And we're focused on improving resiliency in the face of climate risk and catastrophes. So that involves things like research, networking, bringing organizations together, but also it's about identifying the holes that we have in the resiliency in the face of catastrophe and climate risk, and actually building solutions to resolve them. So from a collaborative ecosystem standpoint, we have carriers, brokers, reinsurers, regulators, government entities, universities, et cetera, a lot of different folks, even solution providers and vendors that are coming together for this worthy cause. So I live and breathe the collaborative ecosystem of bringing disparate organizations together to address a need for all every day. But what I'd like to do to get started is I'd like to turn it over to each one of our panelists, let them introduce themselves, but then also let them talk about one of the collaborative ecosystems that they've been part of that they feel is successful. So, John Lewis, let's start with you.
Thank you. So Jean-Louis Monnier, I had insurance-linked securities for Swiss Re. So within Swiss Re, you may think about Swiss Re, the insurer, the reinsurer. I'm in the Alternative Capital Partners group. So we actually cede risk to capital markets. And so I joined Swiss Re over 20 years ago, and we effectively at the time started what I think could qualify as a collaborative ecosystem in the creation of the alternative capital markets for insurance risk. So this was a time where the market was very small, and Swiss Re realized that it needed ultimately additional capacity, especially on the peak perils, in order to respond to the growth in risks that a reinsurer would have to deal with. And so we promoted that market. We, at the time, even issued risk to make sure that investors would have enough risk to invest in, because they were themselves, raising capital. We trained them. We provided some research. We provided some valuation services, which we still do today, so that they could value their exposures, and really tried to expand that market. It's not a surprise that it started a bit more than 20 years ago when the modeling agency capabilities really developed. So that was one part of the ecosystem. Another part as well was, the need sometimes for reporting agencies, especially as a reinsurer. We needed to get the industry loss accurate. So Swiss Re pushed greatly the initiative around the creation of perils, which was then also used successfully. And obviously, you needed, the investors to grow. And fast forward to today, this is a $100 billion market. The cat bond market is getting close to $50 billion. And what's interesting, because we talk about ecosystems, but I think they can be of various scales. Now this market is providing capacity to some initiatives which themselves I think would qualify as collaborative ecosystems. I'm thinking about, for instance, the transactions we've done for the World Bank, where the market as a whole has been very supportive of both innovation and also additional perils, and in supporting resiliency in a number of initiatives. So I'm thinking about transactions that were done, for instance, a fund for natural disasters in Mexico, so providing disaster relief after an earthquake. So capital markets were big supporters of this. And probably the project that I'm probably the most proud of is the Pandemic Emergency Facility, which was designed after the Ebola crisis of 2014, and with a desire to create a mechanism so that developing countries could get access to funding quickly in the case of the emergence of a pandemic or other emerging disease. And this transaction actually was 2 years in the making, got placed in excess of $500 million of capacity was seeded. And there was a payout on COVID-19 pandemic on the portion that covered coronavirus. So I think we worked with the World Bank, there were donor countries, WHO, and Swiss Re and other partners and investors.
Absolutely. Paula, would you introduce yourself and talk about one of the success stories you've seen in ecosystems?
Thank you. Thanks. It's a pleasure to be here. Thanks for having me and Howden in the panel. So this is a fascinating topic, and I wanted to share with everyone that we were preparing for this panel and thinking, what is a collaborative ecosystem, right? We all had different views, but in the end, I think we all came more or less to a collective view. It's really about all the partnerships we've been creating and how we're leveraging each other, but building and complementing each other. And in terms of my own experience, I work on climate risk and resilience, as you see from my title, and I've been working on climate risk management and resilience and adaptation for now more than 15 years, on the reinsurance side, then on the brokerage side, and always trying to push our industry to develop and implement solutions that reflects the needs of communities that are feeling the impacts of climate risk. We used to work only in developing markets. That's no longer the case. So I would say historically, collaborations that have impacted my own experience and career have been those on PPPs, public-private partnerships, where we're working with governments and donors and multilaterals, as Jean-Louis was mentioning, and our sector in order to develop and implement new solutions, and you need those collaborations to implement. It serves us not at all to create a product in our office and then go back to the communities and pretend that it's going to work for them. And it's been really interesting to track the renewals of all these products and improvements to them to understand if they actually serve. I think nowadays, when we are facing the double crisis of the twin challenges, really, of climate crisis and biodiversity loss, we are set to think of our industry working in a different ecosystem. We've always had this essential economic role of allowing advancements, where unlock the flows of capital. And we presented last week at COP29 in Baku a new paper, which is the Great Enabler, in which we are pushing for the role of our industry to help foster this collaboration, where we use our expertise in order to unlock capital flows to transition products, to climate solutions products that embrace nature-based solutions in our race for adaptation, that embrace all the capabilities we have from the different solutions we can develop, which embrace data and technology, which is what we're going to be discussing today. So I would say historically, collaboration has been of the essence, and moving forward, I really don't see a different way. So very welcoming this discussion today.
Thank you, Paula. Karen?
Thank you so much. Hello, everyone. I'm Karen Sack. I'm the Executive Director of the Ocean Risk and Resilience Action Alliance. I do not have an insurance background. I come from an ecosystem of the ocean world. It's the biggest Earth system. 80% of biodiversity on our planet comes from the ocean, and I am a political economist and lawyer, international lawyer by training. And about 6 years ago, was approached by some partners at XL Catlin at the time, and they were interested in the issue of ocean risk and the emerging threats from a heating and a changing ocean, particularly after the hurricane season in the Caribbean. And we co-hosted an event in Bermuda called the Ocean Risk Summit, which brought together leaders from insurance and finance, civil society, academia, and government. And what we established was that we all spoke completely different languages. We didn't understand one another. And that if we were going to tackle this issue, it was going to be really important for us to get together. Fast forward a few years, we established the Alliance, AURA, We now have over 100 members, which include all of the G7 countries. We've been endorsed twice by the G7. We also have members that are what we call big ocean states, the small island developing states, so Maldives, Fiji, Palau, Sri Lanka. AXA is our lead global insurance partner. Deutsche Bank is our lead banking partner. And the Stockholm Resilience Center is our lead science and knowledge partner, because everything we do is based on science. Howden is a member of AURA, as we partnered as well with the Swiss Re Foundation on incubating products. And what we do is focus on looking at the global south, and given that 40% of the global population lives within 10 kilometers of the coast, and 250 of the world's largest cities are located within coastal areas, how do we build resilience to change through insurance and finance products? And our goal in our big ocean space, which is actually very little, so Sustainable Development Goal 14, which is life below water, is the least funded sustainable development goal. 0.01% of climate finance is invested into the ocean. And so our goal is to activate at least $500 million of investment into coastal and ocean resilience through finance and insurance products by 2030, and in so doing, build the resilience of 250 million climate vulnerable coastal people. So we are all about the collaborative, cooperative ecosystem, and we have worked with partners, and we can talk as we go on about. We've got parametric measures, parametric insurance for coral reefs, livelihood insurance for small-scale fishers, risk assessments that enable insurers to make decisions about whether the vessels that they are insuring are involved in illicit activities, and a coastal risk index, which shows how the loss of nature, and Paula was talking about nature-based solutions, can actually have huge detrimental impacts on assets, resulting in stranded assets and huge costs for the insurance and the finance sector. So lots of exciting stuff, and look forward to discussing it.
Absolutely. Dickie, you're in a little bit of a different position than everyone else on the panel, so
I usually am.
introduce yourself and talk about the successful ecosystem.
Thank you, Christopher. So I'm Dickie Whittaker, and I've got a fairly long career in the risk space, both in the US and Europe. Used to work for a very large reinsurance broker responsible for analytics in different locations. And then I sort of got into the collaborative space about 12 years ago, actually a little bit longer than that maybe. And I've started or co-founded 3 companies that are funded by the insurance and reinsurance industry that are all about collaboration to solve some specific problems. And I think the one that is the most interesting as an example of what you can do and maybe what we need to do is one called IIS Loss Modeling Framework. So that was a platform and a community that I started about 12 years ago. And its function was to build a platform to consume catastrophe models that is open source and free to use, to help break down the barriers of getting models into the marketplace, which would serve both the insurance and reinsurance community, but also developing countries. So we work a lot with a whole host of different people, including the Insurance Development Forum and the World Bank and Asian Development Bank and other development banks too. And as a result of that 12-year funding, all of it, I should say, or almost all of it, coming from the insurance and reinsurance industry, we now have sort of 19 model providers and hundreds of models. We curate some data standards on behalf of the insurance industry, which I would say is it's like the most boring thing you could say on a platform like this, but one of the most important, because if we don't have common standards from which we can trade from, then it makes our lives so much harder. And one little, not that little fact, the data cleanup cost of the insurance and reinsurance industry from the corporate world into the systems that we need to manage risks costs annually $24 billion. And somebody mentioned this yesterday and said, where are we and how is AI going to help it? Well, AI will help that, but there are some initiatives that aren't trying to clean up the data more efficiently. I would say that is a second order problem. The first order problem is, can we not get that data in the right format, in the right way that we can use it automatically into our systems? And there are some things we're involved with, which are going to be doing that now. That and the new global exposure model, which has 93% roughly of the world's buildings in it, are a couple of things we've done recently, which most people will go like, well, that's really hard to do. Or maybe people say it's impossible to do. So stuff isn't impossible some of the time anyway. You can get this stuff done. So lots of opportunity, and we've done a fair bit, but lots more to do.
Absolutely. So, Jean-Louis, you mentioned perils, and the work I think that perils has done outside of the U.S. market is huge, but we don't have anything that's the equivalent of that in the U.S. yet. Can you talk about having experience with how perils came about? Maybe explain what perils is for those that may not be aware, but also talk about, if we wanted to do something like that in the U.S., what are the challenges that we would have?
Yes, so how perils came about, it was a time where there was no industry index really to talk for in Europe. And at a time where, some contracts were being done using, like research publications and so on, numbers that were not meant to be used this way. So there was, I think, an intense interest for the industry to have a source of reliable loss data, but also exposure data. Because one of the work that Perils has done is actually create effectively a sense of the industry exposure database by getting information from insurance companies. So in that sense, this is the one thing that we think that Perils is doing very well. It's not just providing estimates of losses in Europe and now some other countries, but also helping the risk transfer by having some higher degree of transparency and exposures. In the US, people tend to be using PCS for these sort of hedges, which PCS is not providing, for instance, these exposures, but for that you need the support for the industry to be able that they would be willing to share. So that's one element. But I wanted to just jump on what you said on the exposures. 93% worldwide. I'm impressed, and it's true that the incentives in the US. We noticed this in the transactions we were doing to have more granularity and transparency of exposures, in my view, really came following Katrina, where you had suddenly, an increase in demand for reinsurance, an increase in premium, and also, at least in our markets, a bit of a pushback against indemnity transactions versus, other type of maybe parametric transactions because of the uncertainty of the losses, and a lot of the losses were flood losses for Katrina. And this pushed actually a lot of insurance companies, I think, to improve the quality of their data so that they would get better rates. So the economic incentives are there, and obviously the US market is, this is where you would put in the effort first because that's where you have the largest amount of exposures and the higher cost in terms of reinsurance. But I'm impressed that you've gathered so much exposure data worldwide.
I'll tell you afterwards. It's not that impressive, really, because I just found it. But nobody else found it first, though.
There you go.
But anyway, there's a longer story. But yeah, no, look, I mean, and particularly here, if you look at the PCS losses from some of the recent hurricanes, like the difference between what we sort of know is going to be the loss and what's being reported is quite high on some of them. That's just not very useful for us.
How important is data? And I'll make this for the group. We're talking about data here. How important is data in what you're doing? Obviously, the collaborative organizations do things like research, and and it's an opportunity for organizations to come together. But it seems to me that foundationally, if you don't have the data, the rest of it doesn't matter. What's your perspective on that? Either Paula or Karen, either one.
I'm happy to start. I think there's a fine line between data paralysis and action. And it was interesting listening yesterday to some of the discussions about data and kind of a focus on better data leading to better decisions. We add an extra layer to that, which we call better outcomes, because hopefully those decisions can result in those better outcomes. Now, in the ocean space, and actually Paolo was talking about climate as well and some of the discussions that are going on, there is this kind of, we don't have enough data, therefore we can't act. But there is sufficient data to act, and there's sufficient data to look at extrapolating from it to take the actions that are needed. In fact, the biggest risk probably is not acting at all. That's the biggest peril that we're putting ourselves under. And so, I think it's fundamental in terms of, and we've developed this open source platform, a climate risk index, to look at mangroves and coral reefs. And if you allow me a tiny little diversion for a second into the world of oceans, because nobody really knows this, but mangroves and coral reefs are amazing, resilient infrastructure. Actually, a coral reef can reduce the impact of wave strength by up to 97%. Mangroves kind of fit within that, the upper 90s as well. So this is natural infrastructure that is sitting there protecting assets that all of you are insuring, and it's being destroyed faster than anything else that's out there. So how do we incentivize the protection of those assets? And this is why we set up the Coastal Risk Index, which is an open source data platform, coastalriskindex.com. And the idea behind it is that you can go and you can actually see, is an airport that I'm insuring, which is next to a mangrove forest, safe if that mangrove is destroyed? And how much value would I lose? The next question for the insurance sector in terms of innovation then becomes, well, okay, how do we incentivize the protection of that mangrove forest into an insurance product so that we are protecting that asset, and in so doing, we're also protecting nature, building resilience to change? It's what I've discovered from, as I said, not being an insurance person, is the innovation is in the application of insurance products to other sectors. All the products exist. And so it's kind of expanding the range of those applications to incorporate things like nature-based solutions or reducing climate risk. Or, as we saw this morning on our panel, you'll see we are all drinking out of glasses here. All the other panels had plastic bottles. So our innovation was to say, no plastic bottles, we're going to drink fresh water out of glasses. It was easy to do, and the organizers were amazing in getting it done. It's a little thing, but it can make a big difference. And those are the kinds of innovations we need collaboratively in a non-competitive way to work towards. And that's the exciting piece of where we can activate data underlying some of the change that needs to happen.
Can I just add one or two things to that? So I think, first of all, obviously, data is important, right? The whole world runs on it, so we can't say it isn't important. But in some ways, I think there are two things that are more important in many cases. One of them, you just mentioned, which is the incentives. So I often have conversations with people outside the insurance industry who may make a statement like, why isn't insurance doing something, right? And I sort of say, well, there are reasons why, and you've got to look at the incentives in the system, or you've got to look at the standards that are being used. So we helped fund a study a few years ago, actually paid for by Lloyd's, which looked at mangroves and coral reefs, which, exactly as you said, but using some metrics that we use more often, showed that you could save about 20% of certain return periods if you had mangroves or coral reefs because of the storms or mitigation on storm surge. So clearly there's value there. But if that information isn't in the models that we use in our industry, then actually it's not known, essentially, because you're then guessing. And you're going like, well, what do I do in this place? Does it have one? Oh, I haven't got the time to look at it, So actually the integration of data sets in a standardized way across the tools we use is actually maybe more important than perfection in the data, I would say.
So you're not saying it's lack of data, you're saying it's lack of aggregation of the data that exists out there.
Or the standards to mean you can accumulate it, because it could be accumulated on platforms, it could be accumulated in models. So we've done some work to try and get all modelers to incorporate this data. I would say we've not yet been successful, actually.
I could add to that and going into an example. So we've heard enough from the hospitality sector, from our clients, about the problems that sargassum is posing in terms of business interruption. So we've now been in a multi-month effort working with Fauna and Flora and other partners in trying to develop a solution. And having worked on parametric insurance for many years now, actually starting in Swiss Re, I would say the dilemma has always been, we don't have the perfect data, but we move ahead and we develop and find a solution. We implement the products. It will help us as we deploy them to collect new data, and we will inform the improvement of these products. We are going through exactly the same now with the Sargasso development process, collaborating with NOAA as well. And there's some data we're expecting to have better at this point. We are within collaborative ecosystems discussing how to apply it, but that doesn't stop us, and it shouldn't stop us. What we need is clear, I would say, guidelines that indicate that our organizations can indeed put resources to doing all of this R&D, among all the innovation that we've been discussing in this conference, to develop these new products and keep on improving, keep on introducing the data. Our industry is expert in managing the data, bringing efficiencies out of it, and actually generating the future views of risk that we need.
Interesting. Do you think that is it a case of maybe we're putting the cart before the horse, so to speak, in that, you know, maybe we should be focusing on the incentives first before we get deep into the data, or is it?
I think it goes in parallel.
Parallel.
So, Karen, you were talking about incentives. We've been discussing quite a bit, and I had the good fortune of discussing this with some of you here, which has been a real pleasure. I think there's many of us that are thinking of the role that our industry plays in generating a public good, which is giving signals. And if we use our capacity to give signals to incentivize the flow of capital towards solutions and the flow of capital towards building resilience. So we were discussing earlier about building codes. Historically, our industry has helped change building codes. There was a gentleman who's leading a Florida insurance company. He was presenting earlier today, and we were discussing over breakfast about this is all information that we can bring to fruition in help inform how, for example, Florida's building codes need to adapt. This is using the data that we have as an industry.
Right.
But we need to be able to incorporate the other sources of data that help us create our own points of view to bring it back to the market. And that's where it's our role as an enabler of change, an enabler of advancements. The other angle to this, we've talked about innovation during these 2 days, is technologies. There's a lot of clean tech that is part of the collaborations that we are developing. And if our industry can step in early on and collaborate with developers so we can understand the data they use, they generate, and use it in order to adjust our products, I think that's also going to help us advance the speed of change that we need.
Absolutely.
Yeah, maybe just a thought on that. I would agree that, like, if you take the US market, definitely some incentives can be created through premiums. You know, you give premium for a stronger roof, for, you know, retrofitting of a house, you know, against earthquake, and the industry is doing this as well. So it's not just a building code; it's also, you know, ensuring that you're giving incentives to reduce and mitigate the risk. Where things are sometimes a bit harder is to influence, you know, areas like, you know, solutions that you raised, where there's maybe no actual economic means to achieve this, or sometimes when insurance penetration can be low, and there can be uncertainty about, you know, also the risk that you're hedging. And I do agree that there's these two elements. One element is the the incentives. The other one is is risk transfer. And for risk transfer, I think parametric solutions can be fantastic at offering some element of hedging because we know the perils very well. We know earthquake. You know, it's the same science that applies different fault lines, but same science generally that applies around the world. Swiss Re has done a transaction in an earthquake-prone area covering archaeological sites. So how do you insure on an indemnity basis historical site? Probably you can't. You know, how much is it worth? What's the cost of rebuilding it? But you can provide some coverage through a parametric trigger, and some coverage is better than none. So I think when it comes to we're at the moment, you know, looking at some climate-related also parametric, and you know, like for instance, drought, and can this be modeled? And then yes, we need some element of data, and then potentially, you know, look into you know, solution. But this doesn't solve the incentives part. The incentive is I think really tricky in the absence of a, you know, of a functioning market, and this is where you need to look at governments, you need to look at, you know, other solutions, and I don't know, maybe you have ideas in mind.
But I think that's where the collaboration and the ecosystem comes into play. So actually there was a parametric product developed for a coral reef in Mexico. Actually, Swiss Re was behind it to begin with. And as different organizations were looking down the Mesoamerican reef, which is Mexico, Belize, Honduras, Guatemala, it's the second biggest reef ecosystem in the world. It's hit often by storms. Thinking about the modeling behind that, we actually approached the Inter-American Development Bank, which did the economic modeling for 3 value sets, the resilience value, the tourism value, and the fisheries value, because those are the 3 biggest economic drivers. So it didn't require an understanding of everything that was happening there. And the IDB did that research and provided it to Willis Towers Watson, Swiss Re, and some of the partners on the ground who built out this product. And it's a really incredible product which is not going to solve all the problems. But what it does is they've worked with the local municipalities in some places, and in others, the tourism resorts to cover the premiums. But in essence, tourism workers are trained in reef recovery before a storm happens. And once a storm hits, there's a quick payout. And those tourism workers who now don't have jobs because nobody's coming there, get in the water and get all the debris off the reef, and they start cleaning it off, which is huge because if you think of the waves that are washing back and forth and all that debris on the reef, it's destroying the reef even further. So the tourism workers are getting paid, the reef is being improved, and there's that quick payout that's bringing the community together. The incentive is, okay, you get some money out of it, but the key risk that is being reduced is the exposure risk and the vulnerability of all of those businesses along the coast. So those are the kinds of things, it's never going to be perfect, but I think the point of where can the insurance and reinsurance sector step up to be forward-thinking leaders in terms of helping to resolve some of the change. And we've seen this again, 20, 25 years ago when the Kyoto Protocol was being negotiated and the reinsurance sector stood up and said, climate change is impacting our business and our bottom line, something needs to be done. The government stood up and looked at it. So what is this next generation of change, of collaboration and cooperation that the insurance sector can bring to the table to help drive the type of resilience measures that all of you are trying to develop? That's what we should be focusing on.
Can I go in?
Absolutely.
So speaking of global accords, I was a few weeks ago at the COP16 on biodiversity in Cali, Colombia. And there were not that many panels on insurance. But it was really a proud moment when stepping out of a panel and talk about the solutions that we put forward to guarantee the performances of carbon credits and going towards its applicability on biodiversity credits, step off the stage. And a person representing family investment funds said, like, finally. Whenever I brought proposals, I asked them, is there insurance behind it? I was like, wow, this is a new one for me. This is great to hear, but it's good to know that on the investment side, they're thinking of it. So in terms of product, product innovation, I think carbon credits and biodiversity credits are a new area where we are working with the data we have, but we're seeing the investment flows going into those industries, and we're going to have to keep on building on the data available and generating new data in order to help incentivize that industry. So that is a big turnaround. But building also on what Jean-Louis was saying, in terms of incentives, I would argue that as an industry, the other essential role we have to play within these collaborative ecosystems is helping understand the risks of the future, not based on current climate scenarios, but future climate scenarios, because that quantifying the impacts of these risks and explaining those numbers to different stakeholders will allow them to better make decisions as per where they're investing to make their businesses sustainable in the future. So in New York Climate Week this year, we launched the Resilience Laboratory. The Howden Resilience Laboratory is a collaboration platform. We're collaborating with Microsoft, and it's an open platform where we're inviting partners from academia, the private sector, governments, etc., to help us process big amounts of data, quantify the impacts of climate risks under future climate scenarios, also turning to financial metrics that different industry stakeholders can incorporate into their strategic decision making. What's the return on investment from investing in resilience? That is what will allow our industry help all of our clients think, how do I better de-risk investments that are going to the right places so that my business will be able to be successful, operational first, insurable second, successful third, under the different climate scenarios?
I think that makes perfect sense. And there's so much money on the sidelines too. I mean, there's, private organizations out there that are looking to invest, but they don't know how to approach us to do that. Yes. There's public organizations, government organizations that have, money that they're sitting on that they don't necessarily know how to connect with us. So I think that connectivity is part of it. But I think that, one of the things that you said, I think that is very important is you can't just go to these organizations and say, give us money. You have to be able to go to them and say, here's data, here's why it's important, and here's why you should think about funding this.
Can I just add something to that? Because I think I feel quite strongly, and I'm surprised it hasn't come up in the last couple of days more, but to me, all forms of collaborative activity are no different from all forms of corporate activity. If you're running a firm and you want to launch a new product or open a small office or whatever it happens to be, you find the right people to do that, and you can do that internally because that's part of your own organization. Exactly the same disciplines need to be provided for collaboration externally. It's just that the qualifications for doing it are usually different, which is pre-competitive, complex, need different thinking. Those are usually some of the things you look to have. And I'm somewhat frustrated that I go and talk to people and I say, well, where are your problems? And they go, well, we got problems with this. I mean, yesterday was one talking about data. The guy from MAPFRE said, we've got an internal project looking at data. Every insurance company has a problem looking at data. So shouldn't we get together to try and fix that problem? Right. And you can go on. And the thing with coral reefs, exactly the same thing. There's been quite a lot of effort on coral reefs. But if we don't make a decision at the corporate level to say, where do we have complex problems we need to solve, and then identify the teams and the partners need to do it, I think we will always have a suboptimal provision of results for those activities.
Do you think the products need to be defined first, though? Because, eventually by the time you get all the data and all that kind of good stuff to be able to prove your cause, you know, a lot of time can have passed. Is it better off to get the industry organization to say, we want a product for this, 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 this. Now let's figure out how to go get the data or figure out how to aggregate the data or whatever steps need to happen.
But you're down 3 levels, right? So
Right.
the starting point might be, how can we be more competitive in this space? How can we cut that 1/3 to 40% cost base that we've
Gotcha.
got? How can we communicate better? How can we solve the protection gap in California? Whatever the question might be, right?
Right.
Whatever that question is, that's the starting point. And then you move from there. And where you end up or how you go through that process depends a lot on the question.
Other thoughts around that same subject? One that comes to mind that I'll just throw out there for folks to talk about, you know, the IBHS is an organization in the U.S. that does a lot of great work. They have their Fortified Homes initiative, and they're starting to get some good data out there to really be able to prove that so that they can go to different communities and try to get them to buy into it. But it almost seems like sometimes it's easier to get the communities to buy into that process than it is to get the industry to buy into that process. How can we incentivate? And I know what Dickie's saying, that, you know, you got to start with the problem, but how can we get everybody at the table to figure out how to address something that already exists? Fortified homes is something that should be in place everywhere as a standard. How do we make that happen?
I think really that's where we need to accelerate the transformation in our industry. And as I was talking about incentivizing resilience, I'm going to share a case with you all. I was at a different broker until a year ago. And in there, we collaborated with the Nature Conservancy and working with the former Commissioner of Insurance of California, David Jones, and his team. We launched a paper that's public where we showcased the methodology to quantify the net present value of the investment in ecoforestry management. And so the hypothesis was the reduction in losses in the future is the amount of money we should be investing these days into ecoforestry management. And that should justify the reduction in insurance premium to reflect the reduction in future losses. We worked in that project also with the US Forestry Service. We went together to visit different communities. The Forestry Service confirmed that there were some communities that way surpassed all the wildfire resilience metrics that they could recommend. We could not find a single carrier to provide capital. That was 3 and 2 years ago. We are still talking about the same. We can bring all of our data and understanding of data outputs forward in saying it's worth it to invest in resilience, coastal, the urban wildlife interface, you name it. But if we don't put our capital towards those investments in resilience,
Right.
what signal are we giving? We need to push the flow of capital towards resilience. And we can do that. We can enable that by directing our pricing to support insurability of those markets, of those communities that are investing on it.
And if I could just add to that, that there's also the issue of scale, right? So the minute you come up with an idea like this, it's either too small or a pilot, or maybe it's too big and the risk assessment hasn't been done. And so stasis is the convenient place to stay. You know,
But not everybody stays, sorry to interrupt. Actually, that deal was underwritten not by the insurance industry, by private capital, using AI-generated models that were trusted more by private capital than the scores that our industry was using.
And I think that's exactly, you almost just made my point for me, which is, where is the insurance sector there, right? Where is that pool of risk capital that could be activated, that's not going to cost a lot of money for those initial investments, that could prove the case for some of these trials. You know, we work with entrepreneurs from Tanzania to the Philippines, and they have these unbelievably brilliant ideas. They are so excited about the work that they're doing. Unlike the Silicon Valley kind of model of fail fast and often, they have one opportunity. That one idea, if it fails, that's it. They're back selling, you know, fruit on a street corner to keep their families alive. And for them to find that little bit of funding, right, whether it's $50,000 or $5 million along that range, it just isn't there. Now, when you look at the vast amounts of capital that is held by the insurance sector globally, where is that cooperative and collaborative ecosystem that's putting some of that capital into, you know, a philanthropic, for want of a better word, endeavor, which is investing in some of these new ideas to show and prove, let's prove the point that this works, so that it then becomes an expandable and investable possibility. And I think that's some of the stuff we've got to kind of unleash, because we simply don't have time. I mean,
Right.
we're on a trajectory to 2.6 degrees Celsius of warming.
So, Jean-Louis, Swiss Re's name always seems to be tied to these different initiatives and things that are coming up. How do you guys think differently? What's a secret sauce that you guys have when you're looking at these kind of initiatives that other organizations seem to have a hard time coming to the table and justifying?
It's probably in our DNA, you know, and it comes from the top, you know, the desire to promote resilience. But I wanted to touch base maybe on a few items. The first one, I do think that when it comes to like fortified roofs, for instance, the experience that I have, you know, with investors is that typically you would get credit for that. You know, you would, even though the models don't necessarily capture, you know, these things, but you would get credit. And I'm optimistic that, you know, investing in resilience that has really like high impact in the short term, it's something that ultimately can be, you know, reflected, you know, in the rates. I think one of the issues we have going forward, both in terms of maybe peril and also, you know, improving resiliency is flood in the US, because we've seen more precipitation-induced flooding, and, you know, you can reinforce a roof. It's hard to move a house. You can't, you know. So this is where maybe through coding, but with decades, you know, of, you know, appropriate coding, you can mitigate the risk. But this is where I think there's probably a, you know, in terms of protection gap, a severe protection gap that needs to be addressed. And I know that Swiss Re, for instance, is investing in initiatives, you know, to both on an indemnity basis or also parametric to cover this. And the parametric side can be useful to effectively cover the non-tangible, you know, like property, or it could be, you know, we talked about disaster relief, or, you know, more the personal elements, and you can have greater flexibility there. So, so to your answer, you know, indeed, I've been working at Swiss Re for 20 years, and I think Swiss Re always, you know, aim to provide innovative solutions to solve, you know, the issues of facing the insurance and reinsurance industry.
Excellent. We've only got about a minute left. I do want to give opportunity if anyone has a question. We probably have time for one or two questions. Anyone? Okay. I don't think we have any up on the screen. Let's go into closing remarks then. We just have a few seconds left. From each of you, what would be the thing, the number one thing that you would want everybody when they walk out of this room to take away with them back to their day jobs?
So I would say collaboration should be strategic. Build it into your plans, and let Christopher I know if you don't know where to go, because there are plenty of people doing stuff already.
I would argue that when you go back to work, try and build the value of nature into your balance sheet. It's been providing businesses with the largest subsidy that we have ever experienced since the dawn of the Industrial Revolution, and that subsidy is being wiped out really quickly. The more you can add it into your balance sheet and account for it, the more we can protect it and build the resilience for future generations.
My suggestion would be think how to use the enabling power of your organization to incentivize climate resilience. It's going to be more sustainable for the investor markets, the asset owner markets, the insurance markets, the housing markets, and the society overall.
Yeah, and I will end on an optimistic note. I do think that both from the insurance, reinsurance side and capital market side, which I experience every day, you have a number of stakeholders that care and that are willing to put capital and risk or capital at risk to support initiatives and welcoming, any form of, new project. Our investor base is very sensible to ESG matters and, willing to allocate significant amount of capital for the right solutions.
Excellent. Everybody can please thank our panel.